So I have question 9. I don't know what chapter this is, but it asks 3 questions. The first question is, list the advantages of the flexible exchange rate regime. And the answer for that is, the advantages of the flexible exchange rate system include automatic achievement of balance of payments equilibrium and maintenance of national policy of autonomy. For question B, it says, criticize the flexible exchange rate regime from the viewpoint of the proponents of the fixed exchange rate regime. And the answer for that is, if exchange rates are fluctuating randomly, that may discourage international trade and encourage market segmentation. This in turn may lead to suboptimal allocation of resources. For question C, it asks, review the above criticism from the viewpoint of the proponents of the flexible exchange rate regime. And for that, it says, economic agents can hedge exchange risk by means of forward contracts and other techniques. They don't have to bear it if they choose not to. In addition, under a fixed exchange rate regime, governments often restrict international trade in order to maintain the exchange rate. This is a self-defeating measure. What's good about having a fixed exchange rate if international trade needs to be restricted? So,
Thank you, sir.
I had chapter 1, questions 3 and 4. The first question was describe major international trends in the past 2 decades, and kind of what it was saying is that rapid international globalization has been rampant, which means more free markets and more trading. And the euro also, or the EU developed the euro to compete with the US dollar. And for number 4, it said, what is good about free international trade? It leads to specializations of goods and services to increase efficiency overall. And some may argue that it's a zero-sum game, but it's a increasing sum game.
So I had chapter 4, question number 5 says to explain the wedge between the control and cash flow rights and discuss its implications for governance. When there's a separation of ownership and control, managers have control rights with insignificant cash flow rights, where shareholders have cash flow rights but no control rights. This wedge gives rise to the conflicts of interest between managers and shareholders. And then number 6, it says to discuss the different ways that dominant investors use to establish and maintain the control of the company with relatively small investments. Dominant investors may use shares with superior voting rights, pyramidal ownership structure, and inter-firm cross-holdings. And number 7, the Cadbury Code of the Best Practice adopted in the UK led to a successful reform of corporate governance in the country. Explain the key requirements of the code and discuss how it may have contributed to the success of reform. And so the code requires that chairman of the board and CEO be held by 2 different individuals, and that there should be at least 3 outside board members. The recommended board structure helps to strengthen the monitoring function of the board and reduce the agency problem.
Chapter 4, question 10. This is a 3-part problem. It's asking to explain free cash flows. So free cash flows can be a useful measure for understanding the true profitability of a business. So this would be the cash flow from operations minus the capital expenditures. And then the second question is asking, why do managers like to retain free cash flows instead of distributing it to the shareholders? This would be to undertake unprofitable projects at the expense of the shareholders themselves. And then having some debt can impose disciplining this effect on the managers and induce them to reduce the waste of the firm's resources. So that is a mechanism that's to solve the problem.
So I have chapter 3, and the third question is, the United States has experienced continuous current account deficits since the early 1980s. What do you think are the main causes for the deficits? What would be the consequences of continuous U.S. current account deficits? The current account deficits of U.S. may be attributed to 1, strong dollar, undervalued currencies of trading partners such as China, Japan, and Eurozone. Secondly, high consumption and low savings in the U.S., and low consumptions and high savings in major trading partners. And lastly, weak competitiveness of the U.S. industries, especially manufacturing sector. If the U.S. deficits continue, the dollar may eventually depreciate substantially, and the confidence in dollar may suffer. And then for the fourth question, In contrast to the U.S., Japan has realized continuous current account surpluses. What could be the main causes for these surpluses? Is it desirable to have continuous current account surpluses? And the answer would be Japan's continuous current account surpluses may have reflected a weak yen and high competitiveness of Japan's industries. Mass capital exports by Japan prevented yen from appreciating more than it did. At the same time, foreigners' exports to Japan were hampered by close nature of Japanese markets. Continuous current account surpluses disrupt free trade by promoting protectionist and sentiment in the deficit country. It is not desirable, especially when it is brought by the mercantilist policies.
So I have chapter 3, number 9. The question was, since the early 1980s, foreign portfolio investors have purchased a significant portion of U.S. Treasury bond issues. Discuss the short-term and long-term effects of foreigners' portfolio investments on the U.S. balance of payments. The answer is, as foreigners purchase U.S. Treasury bonds, the U.S. balance of payments will improve in the short run, but in the long run, U.S. balance payments may deteriorate because the U.S. should pay interest and principals to foreigners. If foreign funds are usually productively and contributes to the competitiveness of the U.S. industries, however, U.S. balance of payments may improve in the long run. I also had number 10, and it was describe the balance of payments identity and discuss the implications under the fixed and flexible exchange rate regimens. And the answer is the balance of payments identity holds the combined balance on the current and capital accounts should be equal in size but opposite in sign to the change in official reserves. So the formula would be BCA plus BKA equals a negative BRA.
Question 7, it was explain how the special drawing rights are constructed. Also, how are special drawing rights were created. It was created by the IMF in 1970 as an asset to alleviate pressure on the US dollar. The SDR is essentially a basket of 5 major currencies, and they're weighted differently depending on the relative importance of each currency in the international trade and financial markets. So the US dollar right now is 41.73%, the euro is 30.93% weight, the yuan is 10.92% weight, the yen is 8.33% weight, and the pound is 8.09% weight, and they change over time.
One that I had was discussing the advantages and disadvantages of the gold standard. So as far as the advantages are concerned, since there's a restricted gold supply, that would kind of limit the levels of high inflation that different countries could have. But on the other hand, the world economy can be subject to deflating pressures due to the restricted amount of gold that is available. There's a balance of payment disequilibrium, and that can be corrected through the cost border close of gold. So it's very important that the BOP stays balanced at all times, and by having the gold in and out of the borders, it will help to balance that out. So the gold standard has no mechanism to enforce rules. So if countries were to implement certain economic policies that would kind of demonetize the value of gold, it would just not be in line with the gold standard. And probably should have said this first. The gold standard is the system by which the value of currency was defined in terms of gold, so for which the currency could be exchanged.
I had chapter 1, so the first question is, why is it important to study international financial management? And it's because we're living in a highly globalized and integrated world economy where all the major economic functions such as consumption, production, investment, and financing are highly globalized. This is owed to the continuous liberation of international trade and investment and rapid advances of telecommunications and transportation technology. It's thus essential for financial managers to fully understand vital international dimensions of financial management. And my second question is, how is international financial management different from domestic financial management? And there are really like three reasons why. First, because of foreign exchange and political risk. For example, for foreign exchange risk, if your company is a major exporter to, say, like Mexico, and the U.S. dollar appreciates significantly greater to the Mexican peso, then your products can be priced out because you're selling in U.S. dollars. And then like an example of a political risk would be, I guess like in the late 1990s, Enron tried to start like a big, I can't remember, like energy company in India, and after like investing like $300 million, India just like shut it down. And then a second reason why international financial management is different from domestic financial management is because of market imperfections. So there are various functions and impediments preventing markets from functioning properly. This includes legal restrictions, excessive transportation costs. An example would be, we talked about it a couple weeks ago with Honda opening up an Ohio facility to get over like import tax. And then the last reason why international financial management is different from domestic financial management is because of expanded opportunity set. So firms can locate production anywhere that maximizes their performance and can raise funds in any capital market where the cost of capital is lowest. And then firms can gain greater economies of scale when assets are deployed in a global basis.
Alright, so I had chapter 4, questions 3 and 4. So for number 3, following the corporate scandals and failures in the U.S. and abroad, there is a growing demand for corporate governance reform. So what should be the key objectives of corporate governance reform, and what kind of obstacles can be thwarting reform efforts? So the key objectives were to strengthen the shareholder rights and protect the shareholders from expropriation by corporate insiders, and some of the reform efforts were controlling shareholders, and managers didn't want to lose their control rights and they would resist reform efforts. And then studies show that the legal protection of shareholder rights varies a great deal across countries, and here's some possible reasons why the English common law tradition provides the strongest, while the French civil law tradition is the weakest protection of investors. So on civil law, the state plays an active role in regulating economic activities and is less protective of property rights. While on the common law, the control of the court it was passed from the crown to the parliament in the 17th century, which is it caused it to be more protective of property owners, and protection was extended to investors over time.
I have chapter 3. Question 1 asks to define balance of payments, and it is a statistical record of a country's international transactions over a period of time, and it's presented in double entry bookkeeping. And then the next question asks why it's useful to examine that information, and the first reason is because it gives detailed information about a country's supply and demand of their currency, and second, it can be used to evaluate the performance of the country in international economic competition. And then an example was like a country experiencing long-lasting balance of payments deficits would indicate that they lack competitiveness within the industries that they're looking at.
So this is the U.S. balance of payments trend from 1960 to 2017. So there was a positive balance from 1960 to 1970, which meant we were exporting a lot, and then after 1971 all the way till pretty much now, there was a negative balance, which means we were kind of an importing country, and there was peak negative balance at 1998 and 2006.
Alright, so my question was from chapter 2, question 2. It's about the mechanism that restores the balance of payments equilibrium when disturbed under the gold standard. And so under this, it's the mechanism called the price specie flow mechanism. And so this helps the base balance of payments to be corrected by a counterflow of gold. And so to illustrate this, suppose that the US is importing more from the UK than it was exporting to the UK. And so gold will flow from the US to the UK as that form of international payment. And so the US gets a decrease in the money supply, which causes price levels to fall, and the US products become more competitive in the export market. And then UK gets an increase in the money supply, which causes their price levels to rise, and then the UK products become less competitive. So this improves the balance of payments in the US, but it hurts in the UK, their balance of payments. But this eventually eliminates the initial disequilibrium and balance of payments.
So I had questions 5 and 6 from chapter 3. So for number 5, we have comments on the following statement. Since the U.S. imports more than it exports, it's necessary for the U.S. to import capital from foreign countries to finance its current account deficits. And so this statement kind of assumes that the current account deficit causes the capital account surplus, but really the surplus leads to a current account deficit because foreign direct investment increases into the U.S., the dollar becomes stronger, and this encourages imports rather than wanting to export things. And for number 6, we have explain how a country can run an overall balance of payments deficit or surplus. And basically, you just want to engage in official reserve transactions. So for a balance of payments deficits, you want to draw down the reserves, and for a balance of payments surplus, you want to absorb that by adding to the central bank's reserve holdings.
So I have question 8, and it's basically talking about a working group of French CEOs that was set up by the Confederation of the French Industry and the French Association of Private Companies to study the French corporate governance structure. So they said that the board of directors should not simply aim at maximizing share values as the UK and the US do, but rather the goal should serve the company, whose interests should be clearly distinguished from those of the shareholders, employees, creditors, suppliers. But still equated with their general common interest, which is to safeguard the prosperity and continuity of the company. And then they asked me to just evaluate that statement. So they said that shareholder wealth maximization is not a universally accepted goal. This is mainly just in the U.S., or that this is an accepted goal. So to some extent, this may reflect the fact that share ownership is not widespread in most countries. In France, it's about 15% of households own shares.
Alright, so I had appendix 1A, question 1. So it says, country C can produce 7 pounds of food or 4 yards of textiles per unit of input. Compute the opportunity cost of producing food instead of textiles. Similarly, compute the opportunity cost of producing textiles instead of food. So country C, 7 pounds of food, 4 yards of textiles. So the opportunity cost for food instead of textiles, you have 1 yard of textiles per 7/4 pounds of food. So 1 yard per 1.75 pounds of food. And then for the opportunity cost of textiles instead of food, you have 1 pound of food per 4/7 yards of textile, so 1 pound per 0.57 yards of textile.
Alright, so I had question 3, which asked us to suppose a situation in which the pound is pegged to gold at a price of £6 per ounce, and the franc is pegged to gold at the price of 12 francs per ounce. We could assume that the equilibrium exchange rate should be 2 francs per pound, but in this case it's actually 2.2 francs per pound. So how could we take situation of this situation, and how would shipping costs play a part of it? And the answer is, we could suppose our goal was to buy 6 pounds using francs, so option 1 would be to choose the foreign exchange market and buy the 6 pounds for 13.2 francs, which would be silly, because you're going to lose money. The better option would be to buy gold in France and then ship it to England. So you buy the gold in France for 12 francs, ship it to England for 6 pounds, and you would save 1.2 francs. In this case, if shipping was greater than 1.2 francs, it wouldn't be worth it. And then the final thing you could do is just to sell 6 pounds for 13.2 francs in the foreign exchange market and make 1.2 francs of arbitrage profit.
So I had chapter 2, question 10, and the question asks, an integrated world financial market, a financial crisis in a country can be quickly transmitted to other countries, causing a global crisis. What measures would you propose to prevent a world crisis? The first one is the multinational safety net, to safeguard the world's financial system from another Asia-type crisis. Secondly, international institutions like the IMF and World Bank should monitor problematic countries and give advice. And third, countries should have domestic savings on long-term foreign investments rather than short-term portfolio. And then it goes on to say there can be other. That's the main three.
I had chapter 2, question 11 and 12. Question 11 says to discuss the criteria for a good international monetary system. There's 3 things that it should provide. First one is sufficient liquidity to the world economy. Second one is smooth adjustments to DOP disequilibrium as it rises. And the third one is to safeguard against a crisis of confidence in the system. And then question 12 asks, once capital markets are integrated, it is difficult for a country to maintain a fixed exchange rate. Explain why this may be so. So the reason is, once the capital markets are integrated internationally, vast amounts of money may flow in and out of the country in a short period of time. This causes difficulty for the country to maintain a fixed exchange rate.
My question was, explain the arrangements and workings of the European monetary system. And the European monetary system was launched in 1979 to establish a zone of monetary stability in Europe. Second, it was launched to coordinate exchange rate policies with non-EMS currencies. And it was also established to pave the way for eventual European monetary union. The 2 main instruments are the ECU and the ERM. The ECU is the European Currency Unit. ERM is the exchange rate mechanism. And the ECU is the accounting unit of the EMS. The ERM manages EMS exchange rates, and the ERM also allows countries whose rates deviate to adjust to keep rates within the EMS standard.
So I had chapter 2, question 13. The first part of the question says, assess the possibility for the euro to become another global currency rivaling the US dollar. So for the first part, the Eurozone is of similar size to the US, and the European Central Bank tries to maintain monetary stability throughout Europe. So it is possible that it could become a global currency. The second part, and if it does become a global currency, what impact will that have on the US dollar? And so the US benefits from having a status of the dollar being like the big global currency, so it can like run trade deficits as we talked about in the chapter presentations and stuff. And it can carry out its transactions without a lot of exchange risk. But if the euro becomes a global currency, then the dollar will then start bearing its exchange risk and will suffer as a result.
Thanks, Jacob. So what I want to go over really quickly, what you guys should do over for the rest of the week and for over the weekend, you should start talking about your portfolios. Yes.
I have a curious question about
Yeah.
the dollar to the euro. Might sound stupid.
No,
But,
that's cool.
if the dollar is stronger than the euro, then why is it that you don't have as much, like the exchange rate is that it's $1 to like 88 cents of the euro? Wouldn't it be that if the dollar is the strongest, you'd be able to buy more of the currency that's weaker? Does that make sense?
The exchange rate can go two ways. They're called cross rates. It's either dollar to the euro or euro to the dollar.
Okay.
Okay, so it depends on how you're looking at it. I like to look at it dollar to the euro because it just makes sense to me.
Right.
So if the dollar depreciates, then the dollar to the euro exchange rate is going to increase. So it's going to cost me more to buy a euro. So when the dollar to the euro, when the dollar depreciates or the euro appreciates, it's going to cost me more to buy that euro. Okay, so that's why I think of it in dollar to foreign exchange. Dollar to foreign exchange, that's the way I think of it because it seems to be easier to memorize. So if the dollar to, let's say, euro exchange rate increases, one day it's $1.13 to buy a euro. Now it costs me $1.15. It costs me more to buy a euro. So that means that the dollar's depreciated where the euro has appreciated against the dollar.
But why, if the dollar is stronger, wouldn't it be $1 US to $1.10 of euro? Why is it that the euro, it costs a lot more than one? Does that make sense?
Yeah. Why does it cost more?
Yeah.
Yeah, okay, so when they issued the euro originally, it came out at 80 cents, okay? So it was a, how do you say it? When they first issued it, they pegged it at some level, okay? So it cost us like $1 something to buy a euro, $1.20 to buy the euro. They came up with an arbitrary exchange rate when they first issued it. It's almost like an index, right? So I'm always thinking in, well, dollar parity with other foreign currencies, right? So if $1 divided by $1 divided by £1, if it equals $1, then you're at parity, okay? So when the dollar, appreciates, it's going to cause the dollar to euro to fall, okay? So it's going to cost me less to buy a euro.
Which is great for us.
It's great for us, but it's bad for them.
Right, and so why hasn't it dropped beneath $1 or gotten close? Because right now it's $1.12.
That's right, but it was at 80 cents at one point.
So it would take.
And then as the euro started to grow, expand, population, economic growth, restrictions on printing of money, which devalues the currency, low inflation rates, that caused the dollar to euro to go to 113. Okay, does that make sense?
It does, but I guess I don't understand then why the dollar is the strongest currency if it costs us more to purchase the euro. Like if someone has 130
Sure.
euros,
Sure.
they get $100 US, but we need $130 to get 100 euros.
Right, so the question is why do we pay more for a pound and a euro as opposed to a yen or a ruble or a peso? Well, one of the reasons is really the institutional frameworks. The EU itself, the coordination of the countries, but you got to remember that the EU and the euro is really anchored by Germany and France. All the other, in Italy to a certain degree, all the other countries are small participants, in the actual economic strength of the European Union. It's really, at the end of the day, it's really Germany. And what does Germany do? Do they import more or export more? So they export more, right? So actually what that's going to do is that's going to cause their currency to appreciate and be more valuable than the dollar, because we import more than we export. And they export more than we import. So through the exports that they're sending out, people are buying more European goods, causing the euro to appreciate, because they're more export oriented as opposed to domestic, economically driven. And that's a big deal. So we get most of our consumption and investment is through imports. We import more than we export because we're a rich country. So we import more. So that's going to put downward pressure on the dollar and cause the dollar to devalue or depreciate compared to other currencies, particularly the European, the euro. Does that make sense?
Yeah, it does.
Yeah. So we're domestically driven. 70% of our consumption and investment is domestic driven, where some of those other countries, particularly Germany, the majority of their economic growth comes from exports as opposed to domestic consumption. Okay, and because of that, the euro is going to be higher than the dollar on from a parity standpoint. The British pound is very expensive too. Okay, and the yen is like thousands of yen, to the dollar, and the same thing with the peso, and that's because that they've created lower denominations, and they've been around a lot longer. The euro's only been around, what, 20, 30 years in regards to currency flows. So that, when you first issued your currency, and if you devalued your currency over time due to inflation, you're going to change the denominations of your currencies and increase the denominations. Does that make sense? That's why the yen is such a weird, currency along with the peso. Okay. All right. So I wanted to show you the. Did you guys want to take a picture of these of the problems? Right now, if you want to take pictures of them afterwards. Okay. How much time do I have? Because I wanted to use the board. See if this works. Hey, will you do me a favor and pull up the Excel spreadsheet, the passive Excel spreadsheet? And when I was saying earlier that the lecture from Wednesday is start thinking about your portfolio strategy. Start thinking about what global portfolio strategy you're going to use to build your portfolio, and start thinking. Come in on Monday and start building the portfolio if you can. Okay. You got to have a strategy. You got to go through the checklist. You got to talk to your team. You got to come up with what your static global portfolio is going to look like. I'm going to kind of push you a little bit. So when, Monday, if you can come in, you've already decided what you're going to build and what you're going to sell and what you're going to market as an exchange traded fund or single account or mutual fund or whatever it is. You guys, if you can nail that down, that would be great. I love it the way the projector always goes out right when I need it. All right. So if I can get this thing to work. Oh, here we go. so here's the, I'm gonna go over this again. So when you start with this, when you start building your static portfolio, you want to start here at the master target portfolio worksheet. For some of you, this is just a review. So once you've come up with your strategy and what you want to build, you go into here. And the way that we did it before is we grouped the companies by sectors. Okay, so if it's going to be tech-dominated, global, large cap, mid cap, we're probably going to put the tech up here. If you want to use defense, which is basically tech too, you would do defense here, and then if you wanted to do, you know, medical tech on a global basis, or maybe telecoms on a global basis. So maybe a third of your portfolio is tech companies, maybe 20% is defense, and maybe the rest is telecom. You know, what is your strategy? How are you going to diversify? And then you're going to have not only have to have sector diversification or sector concentrations or allocations, but you're going to have country too. I wouldn't do a pure, like, German multi-sector country fund. I may do a global fund. If you really want to do a German portfolio, you know, country fund, let me know. I'll probably let you go ahead and do it, but I'm more interested in a multi-country fund or multi-regional fund based on some type of sector diversification. Okay? Then there's only two things you need to do. And use, again, use ADRs. These are foreign global companies that are traded on the New York Stock Exchange or the NASDAQ exchange. That way you don't have to do any currency conversion. So the stocks are already corrected, they're already adjusted for currency, okay, their currency. So I'd pick ADRs, which are basically foreign countries that are traded on New York Stock Exchanges, okay? And then what you want to do is you can use the total market value or market cap of their equity. So you can use shares outstanding times the current stock price and put the value of their equity here. You can use revenues or EBITDA if you want to do that too. Some kind of, this is the scaling factor. So what we're doing is we're weighting, in this example, is we're weighting the portfolio based on total revenues for the individual companies. It's more correct to use equity as opposed to revenue, but you could use revenue as the weighting factor. So what we do here is it sums it up and then divides it back and then sets the static weights, okay? You may need, in this case, as you can see, when we built this domestic portfolio, Apple was taking up basically 17% of the total portfolio. So that's an unconstrained condition within the portfolio. You may say, I don't want any stock to have more than 12 or 15%, let's say 12% of the total portfolio. So what you can do is you can start taking Apple's total revenue, start taking it down to get it to 12. And what it'll do is it will redistribute the weights to all the other stocks within the portfolio. So you may have to do some calibration to get these weights to where you want them to be based on your minimum and your maximum constraints. Okay, that's what we do when we're building these portfolios. We're going to have an unconstrained, and then we're going to start playing with it to then get the weights to where we want them based on some minimum or some maximum. It doesn't make sense to have zero weight of a stock in your portfolio. You should have at least 1 or 2% exposure within the stock as you picked it, and you said it was a good stock, and it should be in the portfolio. It's not going to have a lot of influence on the portfolio, but again, you picked it for a reason. It should have some kind of weight in the portfolio. So once you've set up the weights, then what you do is here we have a target portfolio size, assets under management of $1 million. You could do 10 million if you want to. It doesn't really matter. I think in one class we did 100 million, but I'll be using $1 million. So what this calculates is it takes the 17% of Apple, multiplies it by the million, and gives the total amount of the million that needs to be allocated to Apple, for example. So in this case, $166,000 of the million is going to be invested in Apple stock. Then what we do is we put in the stock prices as of January 1st. Okay, you do January 1st. So then what we do is we take the stock price and we divide it by the value, the amount that we're going to invest in Apple, and it gives us the number of shares. Okay, and then these share allocations don't change. Okay, we should be doing a rebalancing every year or every quarter. That's just too dynamic in the situation. I just want you to see how to build these things and what the impacts will be. So then once you get that all set up, and you put it in here, this is the input page, you're going to put the stocks names in here, you're going to tell us where they're from, you're going to put in the sectors here, you're going to put in their tickers here, you're going to put in the prices as of January 1st, and you're going to use the probably 2018 revenues or 2018 total market caps to get the weighting scheme. Okay. Once you get that, it becomes very simple. So here you go to back test number 1, which is 1 year. You don't have to do anything. You put in the share prices as of January 2018, and what it's going to do is it's going to calculate the annual return. So in this case, here the portfolio did 18.5%, the stock market did using the S&P. We're going to use the MSCI, okay, MSCI Global ETF as the stock return. That did 15.4%. We did 18.5. 18.5 minus 15.4 is going to give us 310 basis points. We basically beat the market by 3.1 percentage points last year, or 310 basis points. Okay, so that's year 1. And all of this is going to then be, all of these Excel spreadsheets are going to be put into the appendix, and then all of the return data is going to be put into a memo. Okay, and I'll give you some examples of that. And then here, back test number 3, you're going to go back and you're going to put the prices of the shares going back to January 3 years ago. That's going to calculate the 3-year average annual compound growth rate. Okay, and the 3-year average annual compound growth rate, you all should know how to calculate that. So this is going to be, this is your original investment, this is the new investment value. Okay, this, as you can see, the equation up there, it's 32, which is the new value, divided by 31, to the 1/3 minus 1. So take a look at that equation. It's going to give you the calculation. Okay. So over the last 3 years, your portfolio return has averaged 12%, where the S&P 500 did 8.2%, which means that you beat the market by almost 4 percentage points per year, or 379 basis points, or almost 400 basis points. That's really good. If you build a portfolio where you're beating the market by that much, there's going to be billions of dollars that are going to come into your fund because you outperform the market so much. Okay. And then the back test number 5, again, go back 5 years to January, put in the stock price. For this portfolio, it did 12.2. The market did 12.1. So it only beat the market by 12 basis points. So it's basically the same. Okay. And then the last portfolio, or the last sheet, is your 10-year. And I didn't fill that one in. I think you guys who did the investments class have it. So you put in the share prices for 10 years ago, it's gonna calculate the average annual compound growth rate. You gotta calculate the average annual compound growth rate for the MSCI Global over the last 10 years. Compare the two, calculate the alpha, and see if you beat the market. When I look at portfolios to recommend to my clients, I don't use the 1 year, I use it as information. I don't use the 3 year, I use it as just information. Same thing with the 5 year, but the 5 year starts to become more important, but the 10 year is really what I look at. How did the portfolio do over a couple cycles, over a couple stock market cycles? Did it outperform? Okay. So again, I wanted to go through that worksheet with you. You can kind of nail down, at least have some discussions, for Monday to come in, maybe start working in the lab, on the spreadsheet. I can sit down with you and work with you and go around trying to hone your portfolio strategies. So you can start collecting the data, coming up with the country, coming up with the sector strategies, start looking for companies and start putting the company data into the spreadsheet. And then I'll go around and I'll audit the spreadsheet to make sure that the average annual compound growth rates on the returns for the 1, 3, 5, 10 are calculated correctly. I'll double check. And we'll get some data for the benchmark index. We'll calculate the returns. For that, we'll start calculating the alphas, and we'll get the passive portfolio done maybe in a couple weeks. Because again, during the week of the final, you're going to be making a presentation on your portfolio and the performance of your portfolio, just like you did in the investments class. So a lot of you already have a lot of that experience. Share your knowledge, explain to people who don't understand or haven't gone through this before. You guys have the templates. Share the templates, particularly the PowerPoint presentations and the memos with teams that don't have it. And that'll increase or speed your productivity significantly, so you can spend more time doing the analysis and doing the research. Okay? Any other questions? If you want to, on Friday, we have a couple PowerPoint presentations. What I'll do is any time we have left, I will focus on the pretest, particularly the statistics pieces where you may have questions. And then I'll go through the pretest, section 2 pretest, which was basically the quiz in 123. And we'll go through that so that people who haven't taken the class will understand that. And then people who have taken the class will have, this will be review, and you'll be on a solid footing. And then I'll start working on the quiz. So basically taking the domestic analysis and turning it into a global analysis. Okay, and on the quiz, what you're going to do is you're actually, the week of the exam is really research. So you're working on the exam and you're conducting the research. You're looking up, printing out currency charts and conducting technical analysis on those, looking for trends, looking for patterns. You're going to be plotting out yield curves, current yield curve 1 year, 5 years ago, to look at the changes in the yield curve on a global basis, not only for the U.S. but also for Germany and Japan, which are two dominant economies, not only in Asia but also in Europe. You're going to need to calculate the spread in returns for the U.S. curve against the Japanese curve and the German curve, because again, interest rates have a major influence on capital inflows into countries. And that's why the dollar has appreciated so significantly over the last 10 years, is because we've offered significantly higher interest rates across the yield curve compared to other countries, and capital flows have just come into the United States to get those higher interest rates. And we provide lower inflation rates too, so people like to invest in the United States. And we also provided higher rates of return in real estate, in stocks, in bonds compared to the world. So we've been just sucking in basically capital from all over the world, which has propped up the dollar and caused it to appreciate significantly over the last 10 years. So really kind of doing application is what we're doing really with the quiz, using the pretest as the foundation to then build on. Okay, so that's kind of where we're going here. I've given you the problems for next week, so you basically have a week to study the problem, then come in on Wednesday, put the problems up on the board, burn through just a ton of problems, we'll work together on those. Again, make this class really active, interactive, and hopefully it'll be fun for you guys. Okay, so if you have any questions or anything, I'm always available. You can text me, call me, email me, whatever I can do to